So, the topic of my talk today will be the role of default and insolvency in macroeconomics. Basically, what I will try to do, the ones who are aware with my work, I'll try to summarize and to emphasize the importance of the contributions that in a long, fortunately I don't even want to remember how many years I've worked with Charles Goodhart on the issue of default and how to model and implement default in economic and financial models, because whenever I see how many years I've been working, it reminds me of my age. But it's a long-standing program that we embarked in the early 2000s with Charles Goodhart, who used to be one of the first members of the Monetary Policy Committee in in the Bank of England, and we met while I was working at the Bank of England. And in fact, he has a great honor. He's one of the few living economists that has a law on his name, the Goodhart Law. So I'll try basically to summarize what we have been doing in our long-standing program on financial stability, modeling financial stability and default. And this talk will draw from a lecture that Charles and I gave in the Bank of Japan a couple of years ago, the famous Mayakawa lecture in the Bank of Japan. I don't have the, can I have the, okay. So basically, some years ago in the, okay, excellent. Some years ago, Bill White, who was also an honorary speaker and giving the Mayakawa lecture, basically argued that he gave a lecture on some alternative perspectives to macroeconomic theory. Because we all know, after the global financial crisis, macro as we knew it, or economic research as we knew it, all changed. Because this singular discontinuity that was brought by the global financial crisis that necessitated and obliged all the academics to rethink the way they were dealing with fundamental macro and financial issues. The main deficiency, and everybody realized after the global financial crisis, is that basically the main problem that all of these macroeconomic models was that the academics primarily focused on the wage price frictions on the labor market and the commodity markets and shocks to productivity. And everybody was basically had a singular focus on total factor productivity analysis, and thereby they ignored the nominal side of the economy, the financial side of the economy. In particular, they were ignoring financial frictions and shocks to credit, confidence, market sentiment, and so on and so forth. Moreover, despite the growing importance of financial markets, leverage and credit expansion, all economic thinking and all economic models assumed by construction that debt was paid in total, and the technical term of honoring and never abrogating your contractual obligations was a transversality condition. It was a condition, a mathematical condition, that basically you would satisfy your budget constraint period by period and intertemporally as well. Thereby, by imposing the transversality condition and in a very ad hoc way assuming all potentialities of abrogating your contractual obligations in equilibrium, basically people ruled out default by assumption. However, this has the following impact and the following consequence, that basically you assume away, and every day, and you know better than most people in academia in Europe, that strategic default is an everyday life phenomenon and it occurs. In fact, default is very related to what sin is to theology. It's regrettable, but ever present. We don't want it, but it's part of our life. And by assuming the transversality condition, you assume away strategic default. Moreover, you also assume that there are no missing financial markets. In other words, that the capital markets, they have all the instruments and all the tools whereby agents that are risk averse and they shun risk, they can insure against all possible eventualities, all possible contingencies. You just have to peruse economic history to see what happened in 1987, what happened in 1997, 1998, what happened with the global financial crisis, to realize that none of these two assumptions are valid in the real world. Default occurs, number one, and there are missing financial markets, and not all risks can successfully be insured. And moreover, this has also modeling consequences when one constructs economic and financial models. If there is no default, then the very concept of liquidity becomes redundant, and if liquidity and default are assumed away, then also there is no need of financial intermediaries. Therefore, the importance of financial intermediation, the banking and the financial sector as being the neural network whereby an economy depends upon is assumed away. So basically, the only thing that consequently you build your models is analyzing and dissecting the real rate of interest and how does the real rate of interest is affected by fiscal policy. So this way, modeling, mainstream macroeconomic modeling up until the global financial crisis assumes away half of the economy, the nominal sector of the economy. Now, what we have tried to do, together with Charles Goodhart, is to include default in banks, so to assume that financial intermediaries, they are not foolproof and they do not exist forever. That's exactly what happened in the global financial crisis. That's exactly what happened in the small banking crisis in the UK in the early 80s. That's exactly what happened in 1997-1998 crisis. So the importance of default of financial intermediaries was an integral part of our research program. It was way before the global financial crisis. And basically, this work draws from another Ukrainian-Russian emigre who landed in Canada and subsequently at Princeton and was a roommate and a co-author with John Nash, a game theorist, my supervisor, Martin Subrick. And he was the first one, to the best of my knowledge, that he introduced endogenous default in equilibrium. He was the person who started modeling default as a decision, a rational decision by economic agents and financial institutions. And therefore, he introduced the trade-offs of defaulting versus not defaulting. In other words, he was the person, and that was our starting point, including endogenous default in economics, was to weigh the marginal benefit of default versus the marginal cost of default. If you are, for example, in one of the Middle Eastern countries, whereby if you default, they start chopping fingers or heads of you, you realize that you shun default. If you are in a more lenient country with respect to the bankruptcy code and the default law, like in the United States, for example, the more you default, the higher the probability to become even president of your country. And then there is Europe and the European bankruptcy system, whereby the bankruptcy code and default is somewhere in the middle. So basically, the trade-off between the marginal benefit and the marginal cost is what determines endogenously in an economy what will the repayment rate be. Moreover, and that's the key aspect of it, that default is compatible with the orderly function of the economy. In other words, many people might think, and many legal experts think, that they should have incentives to shun default altogether. It turns out when you cannot insure against all unforeseen contingencies, and when there is a possibility that you will default due to ill fortune and not for strategic reasons, that this kind of default is welcome. Why? Because if you are in the Saudi Arabian default code where they cut your head if you default €1, then nobody will ever take any risk. And we know risk and uncertainty is what drives investment. So if you kill completely the risk-taking behavior, then you will also kill completely investment and so on and so forth. Therefore, by continuity, the argument goes that the optimal bankruptcy code, the optimal default code, is neither to be very stringent or very lenient, to be somewhere in the middle. So, and this is basically the big theorem about regulation. It's not a matter of the amount of regulation, but what matters is to have the right regulation. So basically, if marginal default is infinite, then no one borrows because you will incur the minus infinity payoff. If the marginal cost of default is zero, then basically you kill the other side of the market, the supply side of the credit markets. And if the marginal cost of default is equal to the marginal benefit of default, then you are in an intermediate equilibrium. Most of the other models which aim to incorporate financial frictions, because after the global financial crisis, as we have already argued, people started realizing the importance of default, how they started introducing default into the model. Either using an exogenous but time-varying spread, or just have default among the non-financial companies. Or together with the previous two aspects, or preventing or forbidding default of banks in equilibrium, which is another unrealistic assumption, despite the quintessential work of Phil Divick and Doug Diamond of bank runs. Basically, you assume away default or the possibility and the probability of a bank run. Our approach basically has default as a central feature, including banks, and hence also a central and a non-neutral role for money, plus liquidity and default premium. And that's very important. If you include financial intermediaries in the way you are thinking, and if you include the possibility of liquidity shortages and default, then inevitably you cannot escape from the non-neutrality of monetary policy. Monetary policy matters, and now we see, after these successive bouts of quantitative easing internationally, and in the United States, and in Europe, now people are worried what will the macroeconomic effects and the financial stability effects be when they will try to unwind the quantitative easing. And this is basically, if you will, one of the most difficult academic topics or topics of policy inquiry, how to undo the quantitative easing or the unconventional monetary policy that was introduced after the global financial crisis without producing another one. However, when one tries to introduce what we said before, default in a very organized way, the problem is the dimensionality of analysis. The dimensionality of analysis and the complexity of the models increases exponentially, and thereby it's not so easy to manipulate, to do analysis, and to solve these sort of models. And plus, you need to roll over your sleeves and work very hard in understanding what your model and what your framework prescribes. But on the other hand, if you simplify, indeed, the old-fashioned models are flexible, they are simple, they can be rearranged to study the issue at hand, for example, housing, bubbles, credit expansion, interconnections among banks and cycles, the Minsky type of argument, cycles of confidence, and so on and so forth. Equilibrium is the maintained hypothesis in all macroeconomic, macrofinance models with cycles around the equilibrium. And basically what people study in policy making is the output gap, is how lower or how higher is the output as compared to the potential or the optimal output that an economy can produce. And most forecasts, economic forecast and financial forecasting models, basically comprise of a combination of a reversion to equilibrium plus some sort of a self-correction of cyclical momentum and overreactions and underreactions. And all of this, they arise from a combination of real, technological, productivity, as well as financial shocks. The worst financial shocks, as experience and economic history teaches us, come after long periods of very good realizations. And that distorts the confidence, distorts, if you wish, how people update their forecast for the future, and then when a bad shock arises, then risk aversion increases, regulation tightens, and thereby this precipitates to a credit crunch and output contraction. And there is basically the essence, what I just described, this mechanism, is what lies behind the debt deflation mechanism that the late Irving Fisher had argued. In other words, the more optimistic we become, the more leveraged we become, the more riskier we become, the more difficult for policymakers is to introduce regulation, and therefore, when an adverse shock occurs, then instead of having a soft landing, you have a very hard landing. Sorry. And this is basically what Hyman Minsky, an American economist, described way before the big crisis occurred in the 70s. And we have worked with another distinguished academic, Sudipto Bhattacharya from the London School of Economics, Charles Goodhart, myself, and a former student of us, Alex Vardoulakis, who is now at the Board of Governors, to model this Minsky process. And we believe that the global financial crisis, basically, it was what you see in the press as the Minsky moment. The Minsky moment after a long series of good outcomes that led people to increase their leverage, led people to increase their risk-taking behavior, and then when the margin calls for the unwinding time arrived, they didn't have the power and the liquidity firepower to unwind their portfolios. And then initially we had Northern Rock, Bear, and then Lehman, that then created the systemic crisis and the contagious effect that spread internationally all over the world. And basically, that describes the stylized pattern of relationships between forecasts and outturns of macro variables over the cycle. Here one realizes that after many good turns, and you see the heavy line is the forecast of the same macro variables, and you see the dotted lines, how forecasts overreact after a series of good realizations. So if you go to any risk management office, if you went of any investment bank before the global crisis, and you said, we're too over-leveraged, we're too overexposed, our portfolio is one-sided, nobody would ever believe you. They would laugh at you because everybody had incorporated a bout of optimism. Likewise, when a crisis comes and you have a downward spiral of economic forecast, then what happens, people start becoming over-risk averse, and regulators become pro-cyclical, and they impose a tighter and tighter regulation that impedes the exit from the crisis. By the way, this is the essence of what happens in the Eurozone debt crisis in Southern Europe. That after the Eurozone debt crisis erupted, then the standard policy that is implemented by the European Commission of austerity and credit contraction and structural reforms, instead of, and if you will, internal devaluation of the countries that were affected by the Eurozone debt crisis, namely Portugal, Spain, Greece, and Cyprus, then this austerity, instead of expediting the exit from the crisis, it basically increased and deepened, extended and expanded the severity of the crisis, and with all the known social and economic problems that have befallen on Southern Europe. Now, the question is whether we can improve and whether we can have good economic forecasts. And basically, the design of regulators and policymakers is to have some sort of alarm signals, early warning systems, in order to be able to fine-tune the financial stability of the system. And that was the original motivation of the establishment of the Basel Committee on Banking Supervision in Basel. That was the original thing, is whether we have early warning systems and early warning indicators so that to avert and prevent the occurrence and the recurrence of financial crisis. And why do we care about financial crisis? Because one thing, if, God forbid, a big industry collapses, a big factory collapses, then it will be affected locally as compared if the banking system collapses. Because the banking system is the neural network of the entire economy. If Skoda collapses, then there will be unemployment, but you can contain the negative macroeconomic impacts. But if the main banks in Czech Republic collapse, then you really have a problem at hand that will spread out in the entire economy. However, all of these early warning systems are subject to two big problems. First is the Goodhart law. In other words, the Goodhart law that whatever policy and whatever statistical regularity you observe between default, growth, and so on and so forth, as long as the regularity becomes transparent, then even the policy is assimilated by agents, and the agents can counter weigh any potential regulation that may occur. Second is that unlike monetary policy, where you target, correctly so, the mean of the distribution, inflation, so you can construct models and you have fewer tools and more well-defined goals, in financial stability, you want to go to the tails of the distribution. You want to go to the left side of the distribution and always to do statistical and econometric analysis in the tails of the distribution is a very difficult exercise. However, we have developed some smart, if you will, indicators like the credit expansion, the leverage, and leverage ratios and so on and so forth, and more importantly, real estate, housing, and property indices. Because if you study the history of financial crisis, of insolvency and default at an aggregate level, behind most of the crisis, there is a property boom. There is a property and a real estate bubble. That's what happened with the subprime mortgage market crisis in 1993 in the US. That's what was happening in 1997. That's what started and instigated the spread of the crisis in 2008. And then, if stress tests can do everything, can solve all the problems, then game is over. However, the problem of the stress tests, they're limited to first round effects. Stress tests cannot see the systemic interactions and how default spreads from one bank to the other, or from one borrower to a bank and from one bank to another, how cross-border contagion and systemic risk realizes. Forecasting procedures after the crisis, people realize that even the stress tests have to be, or the value at risk models have to be updated. What they did, basically they use risk spreads. And basically quantitative easing, the idea of quantitative easing, as the risk spread, credit default spreads increased, then people use quantitative easing as a means to narrow down these rising spreads due to higher default premia. That was the whole idea. Is an old way of restructuring debt, if you wish, and dealing with default, which is monetized debt. You monetize debt, by doing quantitative easing, you raise prices, and therefore the real value of debt dissipates because the nominal values of debt are constant. Then you increase the denominator, that are the prices, so the real value of debt is lesser and lesser. And until recently, in order to handle default of a globally systemically important financial institutions, we had three alternatives. The alternative number one, which has been used in investment banking over and over again, is to have an assisted merger with another stronger bank. In the 70s, that game was called nationalization of the banking sector. In fact, in the 70s, most of the European banks were nationally held. And even now, you have the Landesbanken that are, from domestic constituencies in Germany, the Cajas in Spain. These basically, they were more or less semi-nationalized banks. The second, the politically undigestible solution, is to use taxpayers' money. In fact, that is what, from a political point of view, made people averse to banking and the policymakers after the global financial crisis, because taxpayers' money had been used. And the third alternative basically was to let a bank go under, to allow bankruptcy, liquidation, and lex generalis, and then recapitalization and change of ownership of the banks. That's exactly what happened in Lehman Brothers and many other banks that went under during the global financial crisis. If I dissect these three ways of dealing with default, or dealing with bankruptcy, basically the merger route increases concentration, reduces competition, therefore potentially increases the deadweight losses of oligopolistic competition. Moreover, many times mergers and restructuring involve taxpayers' money that basically it is very politically undigestible from an implementation point of view. And finally, it can weaken the initially stronger bank. And that we have seen that when they nationalized banks in effect and they put HBOS to the Lloyds TSB, the Lloyds TSB bank that was a perfectly healthy and well-run bank, then it started having problems because it was contaminated by a much weaker bank. They threaded through the crisis, they muddled through the crisis, however, the originally stronger bank, Lloyds TSB, was weakened. And that was more or less the route that was chosen during the crisis, both in the United Kingdom as well as in the United States. Liquidation was shown to be a disaster, but, and that's what was happening with Lehman and so forth, but on the other hand, recapitalization using taxpayers' money, as the case was in Southern Europe, basically proved to be too expensive. That was Iceland. It was a way too expensive option to recapitalize using the money from the taxpayers, and or politically unpopular. And when I say politically unpopular, that had serious economic consequences, because the rise of non-mainstream parties like the Podemos in Spain or the Greek government was a direct outcome that people basically responded to using taxpayers' money to resolve the financial crisis. So basically, the policymakers, they were aware of these problems and the shortcomings of mergers and the shortcomings of recapitalization using taxpayers' money, and they searched for alternatives. And three such alternatives were basically the improvement of the liquidation process, the shift of the burden of loss to the bondholder, and prompt corrective action. In other words, focus on preempting a crisis rather than managing ex post the crisis. And the best, these are the improving the liquidation process, the shift of the burden of a loss to the bondholders, and prompt corrective action. And the single manifestation in the United States of these alternative methods is the famous, by now, Dodd-Frank Act, where basically you had an enactment of a special resolution regime that was not present quite clearly before the global financial crisis. In fact, very correctly so, after the bank run of Northern Rock, Paul Tucker, who was at the time the Deputy Governor of the Bank of England, and a colleague of mine, argued that the problem with the Northern Rock was a regulatory underlap, not overlap. They were issues that had not been properly designed to deal with special crises. Then, basically, the Dodd-Frank Act introduced living wills for the systemically important financial institutions. So in case that something was going wrong, there were rules and conditions how would a crisis in a particularly systemically important financial institution should be unwound. Then the Dodd-Frank Act cared and offered an orderly liquidation process and basically asked banks to make any residual costs. However, still there were timing problems involved, namely there were problems on whether the closure can be done soon enough in a timely and orderly fashion. Preparing living wills, the ones of you that have been involved from the legal aspect of preparing a living will is a nightmare. It takes forever and is very expensive. And the cross-border problems, particularly in the European Union, whereby the cross-border problems, whereby when you don't have a European banking, when you don't have European banking union, then from a procedural point of view is virtually impossible. And then, last but not least, is how should you enact these clauses in an ex-ante way, an ex-post way, or via taxation. And therefore, with all these problems about living wills and preemptive corrective action, so Europeans, what did they do? This is, I call it, the Schäuble solution. Basically, they shifted the burden to the bondholders. And that's basically bail-ins, and the first bail-in we had in Europe was not what happened in Cyprus, was the private sector involvement that happened in Greece. Why? Because the crisis in Greece erupted in 2010. Well, it was simmering before that, but it erupted in 2010, in Ireland 2011, and instead of doing a restructuring then, they waited for 2 years so that everybody to offload the government bonds that they had back to the Greek banks and the Greek pension funds, and then when the PSI occurred, basically there was a bail-in and it was a disaster of the Greek banking system. And as it has evolved subsequently, we have seen that the Greek banking system is virtually in intensive care, if not out of business. Now, the Europeans opted for convertible bonds, triggering conversion rates of these convertible bonds so that to transfer the blame to the bondholders, the idea being to increase the market discipline so that the bondholders to be more careful where they invest the money, and they had statutory or contractual bail-ins as well as collective action clauses for European government debt, so that to be able to restructure and offer haircuts and losses to the private investors. However, the choices of triggers and conversion rates, some of us have been involved in these negotiations after default, how you have conversion rates and the rest of it. This type of business is very, very tricky. The market is thin. There are not other levered funds. And actually, this thing, as we have seen in Southern Europe, has not decreased substantially political unhappiness and has not restricted political unrest in Southern Europe. you may think of these corporate finance, debt restructuring things that being appropriate for individual firms or individual banks that from a systemic point of view bails in and transfer of the cost to the bondholders is both economically as well as financially untenable. Concluding, I will try to make in a nutshell to summarize the protective corrective action that was established by Fiducia. It was a very brave act, but exposed after what happened in the global financial crisis, we realized that it failed entirely, and believe it or not, the reason, the fundamental reason that this kind of a regulatory policy failed was not economic but accounting. Because all of these ex-ante rules, non-discretionary rules, depend on accounting variables. And as we know, accounting variables, when a crisis hits, become irrelevant. They do not depend on market indices that reflect via efficient market hypothesis and rational expectations market changes more accurately and in a more timely fashion. And therefore, equity market prices are better and they were not used. Of course, the equity market prices, we know this from credit default swaps, when you go short or flash crashes and so on and so forth, have their own problems, but they are much more responsive at the time of crisis than accounting rules. Now, under Fiducia, below 2%, the law and the rule is you close and you're under receivership and you recapitalize, and basically the preference is for recapitalization or temporary public ownership for any systemically financial institution. And that's exactly what happened under Tim Geithner and the Paulson administration after the global financial crisis. This latter of temporary public ownership for any distressed, systemically important financial institution is not being taken regularly, primarily for ideological reasons. In fact, that was one of the main problems that prevented Europe to get out of the crisis as efficiently as the United States did. Therefore, the resolution process, despite the realization that default has been involved and has been included in our analysis, is still an open question. The jury is out, but the verdict about the optimal resolution and debt restructuring processes is not in yet. Thank you very much.